Hey there, students, and welcome back to this depreciation series. Now, in this video today, we're going to learn how to calculate declining balance depreciation. Now, why is it called declining balance? That's an interesting name. Now, the reason why it's called declining balance is because you will depreciate this fixed asset a lot in the earlier years and less in later years. They call this accelerated depreciation. Now, declining balance, where does that come in? Well, you depreciated a lot up front, right? So the balance in that depreciation account will go down in the later years. The reason why is because every time you depreciate it, the next year, you'll depreciate it by the book value. And the book value is cost of that asset minus accumulated depreciation. So once again, with this declining balance, you depreciate more. So depreciate a lot in earlier years, less in later years. Simple as that. Now, how do we calculate this? Well, there's actually a few steps. This is a little more complicated than straight line or units of activity method. The first thing we need to do is go ahead and calculate our cost. So get the cost of the equipment. Cost is always first. Now again, cost, whatever is needed to get that asset ready for its intended use. It could be paying off property taxes that you inherited. It could be installation costs or shipping costs or insurance, that kind of stuff. Whatever is needed to get that asset ready. Now the second step here, we need to go ahead and get our rate of depreciation. How do we do that? Well, all you do is you take 100% and you divide it by the useful life of that fixed asset. Now, again, this is declining balance. Now, if this were double declining, you just take that rate and you multiply it by 2. That's it. And I realized here I spelled declining wrong. But I think you get the idea. I'm going to go ahead and do this so you have it. So there's that. Let's plug that in there. Okay, so once again, get your cost first, then get the rate. Now next, we're going to go ahead and use this rate and multiply it times our book value of that fixed asset, whatever it is. It could be a vehicle, a computer, it could be a piece of machinery. There's a lot of different types of fixed assets. Now again, land, you do not depreciate that. And this will equal your depreciation expense. Now next we're going to do a practice problem, and I'm going to show you a really cool method on how I get accumulated depreciation, book value, depreciation rate, all of that stuff within one single handy little chart. So let's go ahead and take a look. All right, now for our practice problem. So this will help you understand declining balance depreciation a little more better. And that's my goal here. So I want to go ahead and introduce you to the concept, and now we're going to practice a problem. So in 2012, Ideal Time purchased equipment with a 10-year life valued at $547,000. So there's your purchase price, very important, $547,000. Now to install and ship this equipment, well, to install it, it's $10,900, and to ship it, it's $7,550. This equipment has a salvage value of $23,200. That's the trade-in value. So using the declining balance method, answer the following. Depreciation expense in 2012. What is the depreciation expense in 2013 and book value 2013? Simple as that. So let's go ahead and take a look. I'm going to show you a really cool way that we can answer all three of these questions. So let's take a look here. Now the very first step, as always, we need to get this cost. So what goes into the cost of this equipment? Well, definitely the purchase price. I don't see why not. That's definitely what it costs to buy it. So purchase was $547,000. Now, we need to go ahead and capitalize costs that will get that asset ready for its intended use. Capitalization, all that is taking an expense and putting it into the cost of that asset, only if it gets it ready for its intended use. This is a piece of machinery here that will be used in a warehouse. So first off, they can't use this piece of machinery if they don't install it. Installation is a must. So let's go ahead and add that in here. Installation. So install, it cost them $10,900. Now what else? I see shipping. You can't use the equipment, right, if it's not shipped over. So you need to ship it from wherever you purchased it from so you can start using that equipment. So shipping definitely gets the asset ready for its intended use. So let's go ahead and add this 7,550. So to ship it, and that's all I see here. So that's going to be our total cost. Let's go ahead and add these numbers up, and we get 565,450. All right, that cost will be very important in a little bit. I'll show you. So next, I'm not going to give you a formula really, but we're going to go ahead and get our depreciation rate, and I'll show you what I mean here. Now, when we get our depreciation rate, all you do is take 100% divided by the useful life, which is 10 years. So that'll be our rate, 100% divided by 10. We'll plug that in here. Now, let me show you here this really cool chart that will make everything nice and neat. So I'm going to start with the date here. Then we'll have our cost slash book value, and you'll see what I mean. This is going to be our rate at what we depreciated at. Then we have our depreciation expense. Then from there, we're going to have our book value at the end of the year. Just like that. So this is a really cool chart that we're going to use here to figure out this problem. Now, once again, what is our rate? Well, we take 100% divided by 10. That's going to be our depreciation rate. So 10%, that's the same down the line. Now, the date, when did we get it? Well, it says at the beginning of 2012. That's when we got it. What was our cost? Well, we already determined that, 565,450. So let's just plug it in. Depreciation expense. All you got to do is take your cost, multiply it times your rate, and that's your expense. 565,450 times 0.10, and we get 56545. Book value at the end of year, all you do is take your cost, subtract your depreciation expense. And that's it. So that's going to be 508,905. Next year, 2013. Well, the cool thing here is that the book value at the end of the previous year, so 2012, is going to be your book value at the beginning of the next year. So we just move that number down. That's it. Multiply that times 10%. And that's our new depreciation expense for 2013, 50,891 rounded up. Book value at the end of the year, or 2013, take your book value here and subtract your depreciation expense. Easy. So 508,905 minus 50891. And we get 458,014. All right, so what are the questions asking? What is the depreciation expense in 2012? Well, we already filled out this nice and neat chart, so all you got to do is reference 2012. There it is, asking for depreciation expense. Bam, 56545. We'll go ahead and write that in. 56545. 545 depreciation expense. Now depreciation expense in 2013, well, just do the same thing. Reference the chart, move over, depreciation expense 50891. Go ahead and plug that in. And then lastly, it's asking what's the book value at the end of 2013? Well, 2013 is here. Book value at the end of the year, 458014. Now, I'm sure other professors and teachers have told you different ways to do this, but I like this way the best. It's a nice and easy chart. It takes a little bit to set it up, but you will make much fewer mistakes along the way. So I highly recommend it. And once again, this is called declining balance because you're declining in balance here. Notice you depreciated higher right here, 56545 in the first year, but it declines in the next year. And then 2014, it'll decline again. So your depreciation over time is less and less and less. Declining balance. Now, one thing I did forget to mention here is that this salvage value, the trade-in value for this piece of machinery, you actually ignore it for declining balance depreciation. You do not use it in your calculations. Notice I did not subtract it here from the cost. Very important. So once again, go ahead and ignore that salvage value. Hopefully that was helpful for y'all today. Again, this little chart will be very helpful for you to calculate declining balance depreciation. Once again, if you have any questions or feedback, please give me a comment. I'd love to hear from you. Also, if you have another accounting topic that you want me to do a video on, comment below and I can help you out. I'll go ahead and create a video for you. Please subscribe if you really enjoyed this channel and all the videos that I will be producing. I'm going to come out with about 3 different accounting videos each week. Also, give me a thumbs up if you like this video. I would really appreciate your support. Once again, thanks for listening today, and I'll see you in the next video.